All right, good morning, good afternoon, everyone. Welcome to my first session. Again, please let me know people in the waiting room. I'm new to all the mechanics, the technicals of sharing and letting in, et cetera, so please bear with me. I have requested topics from you guys. And I have a few different things I want to talk about. I have up on the screen the first question, which is commissions. Everyone's always wanting to know how they can reduce their commissions unless they're at Interactive Brokers or Tastyworks, which have greatly lowered commissions. Most people are at Thinkorswim, or a lot of people, and there's been a lot of questioning on how we get our commissions lowered. So I have up their commission structure. I had a pretty extensive conversation this morning with them, and they basically said that they look at a 2-month rolling average, and they want you to be trading about 100 trades per month, which will lower your commission from 225 down to 210. If you break above 250, they'll decrease to $1.85 to $1.90, and above 500 a month, they'll decrease to 175. So the way he worded it is, if anyone gets into these ranges during this 2-month period, they will lower your commissions if you ask. They're not just going to automatically lower the commissions. So here are your benchmarks. If you get up above this 100 mark in a 30-day period, I would call them and ask. And if you pop above the 250, call them back and ask again. Interestingly, he also said that if your commissions are lowered, they are virtually never raised again. And I said, well, what if you quit trading for a year? He goes, we don't raise the commission. He goes, I don't know what Schwab's going to do in the future, because Schwab acquired Ameritrade recently. But their policy is, once they set the commissions, they leave those alone. So you can look at your trading and see where you are. And if you're close to one of these benchmarks, maybe you want to jam a few extra trades through to try to get your average lowered permanently. So, that's pretty much what I found out there. Does anyone have any comments or questions on that? Anyone have anything to share? Okay, I assume you guys can hear me. Yes. Okay. So Dwayne asked, are these futures? These are for futures and futures options. So everything we basically trade has this commission structure. So yes, this does relate to your futures options trades. Okay. Any other questions on that? All right, I'm going to move on to the next question. It's a little bit meatier. Bill, BT Trading. Bill, let's see, Bill's in here somewhere. There's Bill.
Yeah, I'm here.
Hey, Bill.
Hey, it's Bill Thornton. I've changed my name to Bill T. It's a bit easier than having 3 different monikers on the site. So
okay,
I've modified it so at least people know who it is. Yeah.
Cool. Well, thank you for submitting your question.
Yeah, no problem.
Yes, Mike, that is the number of contracts. So when you do a 111, that's 3. When you do a 112, that's 4. When you enter and exit a 111, it's 6. So they can crank up pretty quickly. I was at 60 some odd trades as of yesterday. I don't know if I'm going to hit 100 or not, but anyway, yes, it is the number of contracts, individual contracts. So back to Bill. Bill submitted a kind of a big topic of discussion in our room. What do we do with losing trades? How is the 111 or 11X strategies? How do they lose money? And when do we know to get out? And what are the triggers to get out? So I'll start off by saying that this is somewhat subjective, because if we think about the 11X trade, we really want the trade or welcome the trade to enter into the profit tent, which is the point where let me set up a trade and I'll share it with you.
Yeah, just while you're doing that, Ed, one of the reasons for asking, I think it's the easiest thing in the world to put a trade on and hit the send button and then sit back and wait for the money to roll in. But we all know it doesn't happen like that. And I always have a challenge on the managing side of things as to what to do and when, mainly more than when, as opposed to what. And that's always a thing, you know, when do you start to look to take action? And, you know, in this type of trade, I'm new to this room and this strategy in particular, a couple of weeks now, but I really like it. And I think it's going to be part of my trading plan to use these trades. But that doesn't mean to say I don't need to know more about how and when to look for things and take action if it is going to go against me, or, you know.
Right.
That's my challenge.
That's super subjective, because as you've been reading in the rooms, some people will take assignment, some people will roll. Let's set up a trade, and we're going to look at the structure of the 1-1X. Okay, so let's do a 1-1-1 first. I've set it up at, okay, here's one at $10 for the put debit spread. I'm using the 59-day expiration, which is October 21st. We set it up so the put debit spreads at 39.20, 38.70. Some people vary this 50 strike. Some people are doing 40. Some people are doing 30. The standard number is 50. I would recommend everyone do 50 at the beginning and take it from there. So, okay, we're paying $10 for that put debit spread. So we want to go out and then pay about $20 or sell a contract for about 20. So our net effect is about 10. So this one sets up sorry guys, I've got a little weird screen stuff going on here. Okay, so this one sets up, we're again in the October 21st, 59-day contract. We have it set up at 39.20, 38.70, 35.30. So on the, you know, on this side of the profit tent, we're looking at making the $50. And then inside the profit tent, we can make $300. So we want to make the 50, as much of the 50 as possible. Bobby has back tested, and there's been a lot of commentary, and he thinks around 65% is the average. As you guys are doing this, you can see that sometimes you get to that 50% very quickly, and even in the 70 and 80% range. So again, you have to have your trading rules set. Do you want to exit when you hit 70%? Do you want to put a trailing stop on it when it hits 70% and goes higher, and then if it comes back down to 70%, exit? Some of these things are going to be very subjective. Everyone wants this to be very mechanical, and it can be, but there are a lot of okay, Matt, I'm sorry. Matt cannot see the screen. Is that correct? Can everyone else see this Tasty Work screen right now?
Yes.
Okay. Sorry, Matt. I don't know. Matt, if you want to log out and log back in, I'll try to let you back in. Go to my participants, see who else is waiting. Guys, sorry, I'm not as smooth as Bobby on this. So, okay. So for those that are just joining, we went through a little bit of commission information, and I will post that later. Thank you, Matt. Good. I'm glad you're in. So I'll post some commission information that I found out about Ameritrade after it's over. So we've set up a 1-1-1 here, and we're discussing how to defend, when to defend, do we defend? This is a classic 1-1-1 set up to take in a $50 credit. If you get inside the 50 wide profit tent, it's going to pay $300, but not immediately. So I want to stress to you guys that the the naked put's wiggling around all the time. And if you have any of these positions on, you see that it moves much more aggressively than the put debit spread does. So anyone that wants to leg into these, I always like to do the put debit spread first and then work the naked put, because the put debit spread's not going to wiggle around very much while we're putting on the naked put. If that's too much, too complicated, too much of a headache, put it all on at once. If you're at Thinkorswim, you can do it all at once. If you're at Tasty, you have to do it in separate tranches. So you're going to have to do I would recommend always doing your put debit spread first, then doing your naked put. On the way out, I would cover the naked put first and then cover the put debit spread, for the same reason that naked put's going to wiggle around a lot more than your put debit spread does. So back to like what I'm thinking and et cetera. So like right now we're at 41.40. You see the little red arrow. And as we go down, you can see the P&L theoretical, and it's not totally accurate, but you can see the loss increases as we go into the profit tent. Now, I do need to clarify one thing. I've done some research on Tastyworks and Thinkorswim margin, and they are dramatically different. So I want to point out to you guys that depending on where you're trading and your setup and everything else, your margin may not always be what it looks like for other people. John, I do not know if the 65% was back tested at 21 days or 14 days or took it to expiration. It's a good question. I'll ask Bobby about that. So again, easy is you put these things on and you do them according to whatever your parameters are. I'm trying to trade by the Greeks, which are delta and theta primarily for our use, our buying power percentage as well. I kind of find buying power percentage can be the most important. If you're going to look at anything, look at that. And then look at your deltas and your theta and make sure they're in the recommended Tastyworks metrics. I can briefly go through those. The delta should be 0.1 to 0.15% of your net lick or less. That's a maximum range. Bobby uses the 0.15%. I like the 0.1%, kind of subjective. The theta range is 0.1% to 0.5%. 0.1% is conservative. And as you bump higher and higher and higher and go to the 0.5, 0.5 is aggressive. So 0.3 is moderate. So if you want to keep things on the moderate end, you'd probably want to keep your theta at 0.3 or less. And then your buying power percentage. So that the buying power percentage is, again, based on the Tastyworks metrics. And at the current VIX, which is just above, well, we're in the 23, almost 24 now. So that puts us in the 35, I'm sorry, go ahead. That puts us in the 35 max. Yes, thank you. Admit all. Welcome, guys. Sorry about the delay. Okay. So current VIX allows us to go up to 35% buying power. Now, I want to make some commentary on, let me bring back this other page. Again, I'm sorry, not as smooth as Bobby. Oh. Having sharing issues. My apologies. Okay, here we go. Okay. So those are just some things, some management things that I want to mention, and we can go into those another time or later on in the session, but those are the basic Tastyworks metrics. If you go into my Ed's Notional Journey room, I have a lot of this stuff pinned at the top of my room. If you're new or you're not aware of the pins, when you go into the individual rooms, whether it's one of the nerd niche rooms or the 111 or the live chat or any of those rooms, there are going to be little nuggets of wisdom pinned to the top. Are y'all all somewhat familiar with the pins? Basically, just go to the top of the Discord room, and there's a pin waiting for you, and you just click it. Excuse me 1 second. Okay. So if we go into the live chat room, for instance, and you hit the pin, I have something pinned there from Cap. Cap had done some little wisdoms. Below that, I have the buying power percentage chart. So you can just see, you can search around as you do those things. Look around in the rooms and see what kind of little bits of information have been pinned up there, and print those out or just make a note of them. They're handy. So I want to go back to like what to do when the 111, 112. Obviously, if you're doing a 112, you're pushing the trade, the naked put way down and doubling up and still bringing in the $20 credit for a net $10 credit. And you're putting your point of danger way further away, but you are doubling up on your naked put, which is a doubling up of your margin and a doubling up of your notional leverage. 1 micro is equivalent to 50 shares of SPY. Little sidebar, I got my name Notional Ed because at the beginning when I first started messaging and commenting, I saw a lot of people over leveraging their somewhat small accounts sometime, and I saw people over leveraging sometimes. In private conversations, it was determined that they had millions in their account and had no idea the amount of leverage they had taken on. So I started ranting and raving about, do you know how much notional value you're taking on, which is simply taking the positions you have. Most of you are trading probably the micro, some are going to be trading ES, some are trading the big SPX contract. So those all are equivalent to some notional value of SPY. So a micro MES is 50 shares of SPY. SPY is 100 shares of SPY. ES is 10 times the size of the micro, so it's 500 share equivalent of SPY. And SPX is 2 times as big as ES, or 20 times as big as MES. So it's equal to 1,000 shares of SPY. So when you're looking at your book, it's good to keep track of your buying power metrics. Excuse me a sec. Got someone else wanting to get in. Okay. You want to keep an eye on your buying power metrics, your buying power percentages. And because, you know, everyone wants to put on one position and take off one a day, and that does seem like fun, but unless you have the buying power to support it, it's a risky venture. So let me pause for a second. Does anyone have any questions so far on what I'm going into? Okay, so let's get into is anyone still waiting in the room that you guys know of? Sorry. Okay. So once you get into a trade, how do I want to manage it? What do I want to do? Well, as you've seen in the last few days, your buying power percentage can rise, and sometimes dramatically, as the market falls. I had a number of conversations with people yesterday when the market was down 100-ish ES points. People were saying, oh my God, my buying power has gone up 10 percentage points, 15 percentage points. what do I do? So the easiest thing for you to do when you find your buying power percentage getting out of whack is to take off some naked puts. That is the biggest source of buying power usage and, of course, margin usage, because it's the source of your risk. The put debit spread is really not a risky trade. It's there for protection. So you want to take off some of your naked puts, and you can do them one at a time until your buying power percentage comes down. It'll adjust every time you exit a trade. And you basically want to look at your campaign of 1-1Xs, whether they're 1-1-1s, 1-1-2s, or both, and look for your highest percentage gain. And if you've just started and you're 4 or 5 or 6 in and you have a small account and all of a sudden your buying power is up in the high 30s, you're going to need to take off a position, even if it's a loser. So generally, if you've been building it for a while, you're going to have some positions that are positive. Obviously, we all want to make 50 or 60% on it. And that's a great goal. And higher is a great goal. I like to shoot for 70+%. And I put a mental trailing stop. Once they get to 70, I like to let them run as high as they can run. And then I'll make a little note of which positions are in the harvesting range. And I'll take those off if we have a slight pullback. Last week when we started a pullback, I took 3 groups of 2s off the naked puts, and then almost immediately began layering in the new 1-1-1. So I took off some older positions, harvested the gains, and then put new positions on. So when your buying power or your Greeks get out of whack, you need to take positions off, and that might be the result of the market moving against you, or you've just inadvertently put on too many positions. I hope that makes sense to you. For the newer people that have not experienced a down cycle, I want to explain to you that the durability of the put debit spread increases as time goes on. So that if you have a 45-day trade and you just put a put debit spread on, most of the resilience of the put debit spread doesn't really kick in until you're about in the final half to 1/3 of the life of that put debit spread. So when you're about 15 days left, it really starts getting sturdier. And as you approach maturity, it gets very sturdy and very protective. And we could switch back. Let's see if I can easily switch back here. Okay. So here, sorry guys. So I'm going to start increasing the days. Okay, this is the T+0 line, which is where it tells you where your break even is. Like if you put on one now, this thing goes down to, it says somewhere around here. Anyway, the T0 line is where this gold line crosses down below and becomes unprofitable. I don't know if I'm explaining that great or not, but I can go over here and click this thing out and we can start clicking future days. And you can see that orange line rising. And as we get out, say a month from now, and we're on September 23rd, you can see that the resilience of this thing has gotten way more productive. So if we go down to 4,000, let's say, in 20 some odd days, in 30 days, we'll have $123 profit on this thing. So we in a way, we don't want the market to go against us, but in another way we do, because we really want to get inside that profit tent if we can, because that's where a lot of excitement starts happening, in addition just to the regular let paint dry type situation. Let me go back here. Hang on, my apologies. Okay, so how do we defend the 1-1X trade? So the first thing is you can take positions off. You can take your naked puts off and reduce your buying power and your Greeks back into a comfort zone. The other thing you can do if your buying power is not too high, like if you want to be at 35 or so and you're at 38 or 39, you can just not put new positions on and wait a day or two. And your buying power, if the market stabilizes or starts to rally a little bit, your buying power percentage will come down back into an acceptable level. The danger with that is that you will, if the market keeps going against you, like if we had a 2% down day yesterday, and today we have a 2% down day. If you didn't make some adjustment yesterday, you're going to be further in the hole, and you can find yourself really having your buying power percentage rip against you pretty fast, pretty quickly. So it's something you want to keep up with. So again, you can take off a naked put. You can take off more than one naked put. Let me scroll down to here. So you can exit positions. You can enter a hedge. So by entering a hedge, you can put on an additional put debit spread or two. You could even do a 3x5 bombshell hedge, which is Bobby's design hedge. Those things are better put on in a low VIX environment. We do not have a lot of hedging talk going on in our room right now. Every now and then discussion flares up. People want to know more about hedges. We will get into more hedging in the future, in future sessions. So brace yourselves, even though volatility is high. I think it's a good subject for us all to learn now, so that we'll have those tools in our quiver when we want to use those. The best defense against a 1-1X campaign going against you is simply keeping your buying power percentage low. And therefore, you're keeping your size low. When you're first starting out and you're building a campaign, Bill, I don't know what you're trading, for instance, or how often you're doing trades. We had Brian, who was, let's see if Brian's in here. No, Brian is not in here. Brian was one of our new traders about 3 weeks ago, and he was pretty zealous about putting on a trade every day, which was great as long as the market was going up. We paused, it started going against him a little bit. He quickly adjusted and realized, okay, I understand now. This can back up against me pretty quickly. I don't want to just run, and you don't want to sprint to your buying power percentage. You want to walk fairly casually toward your buying power percentage when you're first building out your campaign. And the reason is you're putting on a put debit spread and naked put or naked puts at the same time. The naked puts are whipping around immediately. Your put debit spread is not moving much because it's new. As it ages and matures, it starts moving around much more and gives you much more protection as your naked puts continue to move around. So the best defense of all is to keep your size small.
Yeah, that's pretty important, Ed. I think that point you made about buying power, I never realized, and yeah, you soon can get in trouble. I trade on Tastyworks, and I follow their mechanics for naked strangles, and it works pretty well, you know, and they're fairly easy to manage, not like an iron condor, which is very difficult to manage if it goes against you. So, but the point you just made about buying power was something I've never really realized. And the more I read on this site from different people, the more I realize that it's very important to keep it in check.
Again, if there's one thing, it's just my opinion, Bobby might slap me for it, and I am trying to manage by the Greeks, which is all the Greeks. It's buying power percentage, it's especially theta and delta. Vega, we've determined, is not as manageable as we would like it to be with the 1-1X campaign. But Vega is one you can also follow, just because you can look at the Vega in your account. It's going to be negative. And basically for every 1 percentage point move in the VIX, if the VIX goes from 22 to 23, your portfolio is going to go up and down by X amount of dollars. And it's basically the amount of Vega you have. So if you have a negative 200 Vega, VIX goes up 1 percentage point, you will be down $200 based on your Vega number. Add to that your Delta. If you have a 50 Delta number, then you're also going to be losing, you're long the market. So if the market's going against you, which it probably is if the VIX is going up, that's also going to cut. So you have the cutting of the Vega and you have the cutting of the Delta into your portfolio. And the higher those numbers are, the more magnified the movement of your portfolio is, the less neutral it is, if you will. So Bill, back to you. And again, this is pinned in my room. One of the best ways for a beginner to trade is, of course, trade the micros. Yes, the commission may be expensive if you're not at a low-cost provider, but you need to trade the micros because you can read all you want, you can study, you can have as many conversations as you want to, but until you experience what happens when the market goes up, or especially the market goes down, you won't have a full concept, in my opinion, of how this works until you experience that. So I usually encourage people to, and again, it varies by person. Some people are going to build up 2 or 4 micro positions, and that's all the buying power they have available. And that's a full book for them. Whether it's those people or the people with $5 million in their account and they're new to the 11X and they're hearing all this stuff and they're drowning in all the information and they're confused, my strongest suggestion is, and this also applies if you find yourself exiting a bunch of positions and you find yourself rebuilding a campaign, build it slowly. So I like to say, treat a micro like it's the E-mini. Treat MES like it's ES. Treat that $50 in premium that you're taking in net like it's 500. And put on one micro 111 or 112, and then wait a week. And then put on another 111 or 112, and then wait another week.
That's exactly what I've been.
Okay, well then you are doing yourself a phenomenal lesson, because, and especially, it's one thing to build that into that rising. We had the 6-week run or whatever it was where the market just went up 11 or 12%. That's great. Well, now we've had like a 3%-ish or so pullback maybe from the recent highs. I don't know. It might not even be that much. I'd have to look. Whatever it is, all of you guys and gals have seen what happens to your Greeks and what happens to your buying power percentage just by sitting and doing nothing. It will go against you, and it can make you nervous. But what you want to keep in mind is you really want there to be some kind of pullback, so you can either keep legging in more positions, which is it's at higher volatility level because the market's been pulling back, and you want to, as Bobby says, be the rat. Look at your Greeks, look at whatever metrics you're using. Bill, you're the exception. If the market falls 2% today and 5% tomorrow and 3% the next day, you might want to somewhere in there put on a second trade, even though it's in, let's say, week 1 or week 2, but you don't really want to be in a hurry. No. Because your main purpose at that point is to slowly build up the durability of your put debit spread, so that when these pullbacks occur, it's going to be shocking when you look at your account and you're like, oh my God, the market's down 2% and I'm down 0.5% or 0.2%. Depending on how you have your account set up, it greatly, I call it a shock absorber. The put debit spread is a shock absorber for the rest of your account. It's not a full hedge. It's not a perfect hedge, but it does absorb the downside action once those put debit spreads mature. So if you might want to look at your book, and if you think your ultimate book is 20 111s, again, I would put them on one at a time for 2 or 3 weeks, and then you'll get a feel for how it's working. And then you can accelerate. Maybe you want to put one in on every other day, or if it's a big down day, maybe put 2 111s on, or 2 112s on. Always better to do it on a down day because volatility is elevated.
Yeah.
That being said, and some of you have been around for a little while, you might find that, oh, the market's unchanged. I'm going to put on a put debit 111. And then the next day the market goes up a little, and then the next day it goes down a little. You might look at that 111, and even though the market's down below where it was when you first got in, your position might still be flat. Again, these are things that you will pick up over time that I find cannot be explained. It's something you have to experience. And again, whether someone has a few thousand or millions, I don't think anyone should be in a hurry to rush into this. This is a learn it, use it. I find it to be very durable if you're not overdone, if you don't have an overly large book. If you're not always pushing the upper limit, in other words, it can be a very boring situation where you're kind of just, okay, I'm up 80%. I'm up 80% on 6 positions. Do I want to take any off? Do I not? That's where you're like in a luxury situation. That's where I want to put trailing stops in on these positions. I don't know about you guys. I hate to lose money on a trade, but I really hate to lose money when I've been profitable and it goes negative. To me, that's like one of the worst things. So I'm not going to let my 80% winner go to a loser that I then have to hold an extra 3 weeks or roll or close or whatever, because basically because I was impatient. So treat the initial campaign like a delicate little egg. And as that campaign gets a few weeks old, it becomes more like a hard-boiled egg. It's not nearly as delicate. So I want to encourage that. Any questions? I'm rambling. I'm sorry. Any questions on what I'm talking about?
Just for everyone's information, I've been doing this 3 weeks now. This is the 3rd week. And I've done precisely 3 trades in those 3 weeks. So okay. I'm taking it very slow in a small account, but it is a live account, which I think is essential for learning. Dummy accounts are okay, but they're really not a reflection of real life. That's just my experience, but don't know what anyone else thinks. But so yeah, slowly but surely, I think, to learn this stuff.
I appreciate you sharing that, Bill.
Yeah, no problem.
Okay, I'm going to go back up and cover defending a losing trade. Okay, so let's define what a losing trade even is. Is a losing trade, so the first thing I have is it by buying power percentage, and use tasty metrics. So we've gone into that pretty well. Again, look for the chart. I have it pinned in my room. Make it kind of your trading Bible. You don't want to ever have that little snip too far away, because it's the best thing you can do to keep yourself out of trouble. And if you're looking at buying power percentage, you're really looking at your whole campaign. You're not looking at an individual trade. So I realize even Bill, you know, you might have your 3 or 4 trades on and one of them's down. You took in $50 and you're down $170 on it. And you're like, oh, what am I doing? How am I doing? What am I supposed to be doing? Well, you're looking at one little piece. You also need to be looking at the entire whole. So building a forest tree by tree is the name I picked for this thing, because you literally are building a campaign, a big bunch of 11Xs, 111s, and or 112s, made up of each one little individual position. So when you're exiting, like, oh, let me see if I have anything I want to exit. Okay, you look at each individual trade, but you're also looking at your buying power. So recently, up until the decline, and as I was building my campaign with Bobby under the mentorship, I found myself looking at a bunch of trades in the 80+% range. And I'm like, my buying power percentage is still 12%, 13%. I don't need to take anything off. I'm just going to let those sit, but I put a trailing stop on it. So I make a little note on a piece of paper, you know, and I date my trades. Like if I enter one today, I date 8/23, and I say if it's a 111, and I label where the naked put is in my little label as I group it in Thinkorswim. So I can look with everything collapsed and see what my oldest trades are, or I can expand and I can look at the percentages, and you just look. And if one, again, I have a whole host of them up in the 80 something percent, I might take some off, or I might not take any off. It gets to be very, and don't feel uncomfortable with that, but you need to have something in your trading plan. How do I want to handle that? If I have 12 positions on and they're all above 70%, do I want to take them all off? You probably don't, because if you take everything off, then you're going to be at restart again. But you don't want to really just be complacent and let everything move against you. And then you found out that, I had all that profit built up over these 2 weeks. And now over the last 4 days, all that profit's evaporated because we've had a 6% market correction. Can I put a trailing stop or trailing profit taking order or not? I don't know about IBKR. I think the best thing you can do is set an alert. So, and that might be universal. Set an alert everywhere on your, if you're short a 3,600 strike, blah, 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 and it's at 80%, figure out what 70% is and set a price target for that option and send it. And your bell will ring, and that's your cue to go to it and exit it. Again, super subjective. I hate to be subjective, but that's the way it's going to be. And look, I talk to people who take them off when they get to 60%. They don't ever get above 60. They take them off, take them off, take them off. Other people are like, I want it to get up in the 90s. I never want to take up. So I can't really tell anyone what to do because it's very subjective. I also want to back up for a minute, if you would. One of the first things I learned in the mentorship with Bobby, and for those that don't know, Bobby started his first mentorship about 2 months ago, probably about 8 or so weeks. I'd have to look for the date. I was the fortunate one chosen, and it's been a heck of a learning experience. I am in my early 60s. I have a deep financial services background in the insurance world. Then I had my Series 7 broker license. I got brokerage management licenses. I managed a day trading room in the 90s. I wrote market commentary for a financial website in 1999 through 2003. I had a mortgage license for a little while. After the mortgage thing blew up, I thought that might be something to get into. And all the while I've been trading. I've never had a written trading plan. So the first thing Bobby gave me to do is come up with a written trading plan. And the concept of a written trading plan, a lot of people might be snickering and thinking it's kind of worthless. Excuse me. It's not worthless. When he first hit me with that, I'm like, what do I need? I'm thinking to myself, what do I need a written trading plan for? And then, okay, I started working. Well, then I realized if all you guys and gals start writing down everything you do and why and how, like what you want to trade, what your parameters are, this, everyone, might be how you set your parameter. I want to exit all 11Xs when they hit 70%, or I want to put a mental trailing stop once they hit 60%. Whatever it is, it's got to be in your trading plan. And Bobby describes this written trading plan as a written, breathing document. So and he told me right off the bat, you can do whatever you want to do. You don't have to just trade 11X. You don't have to trade micros. You do whatever you want. But you need to, I want you to trade by the Greeks, which was my goal. And you have to have a written trading plan. And whenever you feel the urge to deviate from your trading plan, you need to look at it. And I'm trying to read my trading plan every morning. It's a weird habit. Sometimes I skip it. It's good to reinforce in your head as the trading day gets going, because if the market's up a bunch or it's down a bunch, you kind of have an idea of how you want to handle it ahead of time instead of your emotions ruling that. So anything is allowed. The written trading plan is not designed to handcuff you, but it is designed to slow you down when you deviate from your plan. So if I want to trade instead of a 11X, I want to trade a ratio spread. I can trade it, but I have to go to my written plan. I'm permission to trade a ratio spread. Hit the save button, and then I can go do my ratio spread. Again, it sounds silly, but Otherwise, and you've heard Bobby refer to it, you've heard other people probably, we're all, human instinct is to go and make the simple complicated. So this trade, once you get the hang of it, is not a complex trade. There's some moving parts to it. And if you're new to these moving parts, as I was at the beginning, then you will have some potential paralysis at the moment of decision. So written trading plans, that's a huge thing. Bobby's also done a lot of psychoanalysis of me. I tend to be very conservative, and he has really pushed his push the button rat mantra, which you've probably also heard him say. He wants us to be mechanical with our entries using buying power percentages, et cetera. Okay, I'm going to get away from the written trading plan. If anyone has any questions on that, please feel free to message me in my room. Feel free to private message me. In that regard, I'm 100% open in my trading room. Private messages, bring them on. If you post something in a private message, don't take it down, just leave it. If I haven't answered you, it's only because I'm not at the computer. So I love the private message conversations. I learn by sharing what I've learned. I learn by talking to others who know more than I do. There are people in our room who trade the SPX all the time, and they've done it for years. They know how to hedge. They know what they're doing. They have it down like breathing. I am not one of those. I have 40 plus years of trading and investing experience, but I am very new to all this theta selling stuff and premium selling stuff. And so I think no matter how long someone's been doing it, there's always more to learn, but it's simple. So keep in mind, once this thing is working, you might get bored if there's not a lot of market action. You're like, Then you'll start reading, and like everyone's doing 30 wide put debit spreads, and some people are doing 40 wide put debit spreads, and some people are doing no put debit spreads. They're just selling naked puts. And that all varies by their risk tolerance, their experience level, and their ability to get distracted. So don't chase the shiny object. And that's one thing that, excuse me just a second. I just had a trade go off and I'm not sure what it is. Ah, okay. So, excuse me, I apologize. So don't chase the shiny object, and the best way to not chase the shiny object is to have a written trading plan and stick to it. Okay, let's go back to if you're we're in a defending a trade, losing a trade. Okay, watch your buying power percentage, watch your Greeks. We already went over the Greeks. I'm not going to go over that anymore. And then, unless you guys have a question. And then some people use a stop metric. And the most common one I've seen is a 3 times premium sold. So if you take in $50 on an MES 111, and that $50 goes to a loss of $150, they would cover it. They would either take the loss, which means they've lost 150 minus the 50 they took in, so they've lost $100, or they close it and roll, or whatever their plan of action is. I don't necessarily like that. I think you should be letting these things run their course, because even a 111, like today's 111 that I did, I have a 35.30 put as my naked put. So we're at 41.30. So that's 600 points. 600 points. So that's something like, I don't know, 18% down. Is that right? 15-ish percent down, something like. Look, if the market drops 15% in the next 59 days, it drops. So if it drops to anything above 35.30, I'm in this profit tent that we were looking at earlier. And I'm going to be wanting to be happy because I will have, let me find that thing. This is, Mhm. Sorry, I'm a sharing goofball. Hang on. Okay. So if we get down to the 35.30, I'm in the profit tent. And if it's if it's quickly, I'm losing money. If it's not quickly, like let's expand this out from September 23rd. This is the October 21st contract. Let's go out to like October 10th. So you can see this big orange line. That's my new profit tent based on this one position. And if we go down to like the 3,700 level, I have a $225-ish profit. I might want to take that thing off right then and there. You know, like don't be greedy and wait for $300. But you do kind of have the luxury of deciding, hey, do I want to mess around because I'm still 200 points above my naked put? It's a subjective decision, and you probably want to look at your buying power and decide. So I'm deviating a little. I'm not really telling you how to defend, but the best defense is to keep your size small so that you don't have to worry about defending. You can let that thing run right up to your naked put and just capture all of that put debit spread premium. Does that make sense?
It makes a lot of sense, but the hardest thing to do is if you put on a trade and the market goes against you fairly quickly, then you sit and you're seeing that negative number go higher and higher. And the temptation is just to, for me, is to either panic and do something. And sometimes the best strategy is to do nothing, but that's the hardest thing of all, to sit there and watch that go more and more negative and not letting time work in your favor with the theta. But that's hard.
And that is a huge challenge. And that's why I encourage people to put on those trades slowly at the beginning. So if it goes against you, it's going against a very few positions, and you have plenty of buying power to keep adding more. And as you add more positions, as the market goes against you, you're adding those put debit spreads lower and your naked puts lower than you were 2 weeks ago when your put debit spread and your naked puts were higher. And everyone in here, probably even you, Bill, if you were looking at your first trade and you're looking at your most recent trade, your naked put might be right in the middle of where your put debit spreads were 2 or 3 weeks ago. I know I have some, So that's kind of weird. And if you think about that, if we have a pullback to your old naked put, like let's say you have a 3,700 naked put, and it's right in the middle of a 36.75, 37.25 put debit spread, like that thing is cushioning, if it has any maturity to it, it is cushioning that newer position going against you. And so it gets a little weird. If you look at the individual positions, it's freak out time. But if you look at the big portfolio, sometimes there's no panic involved at all. So let me take a minute because I see I'm really taking too much time on this. I apologize. I have one person to let in. Okay. Let's say you buy a position at $10. Like, let's see what or a $20. Okay, so let's say we went in and we did this 35.30. I think I'm sharing this. Okay, and you get $10 net commission on it. Okay, and then some time goes by and the market starts going against you. And this $20 naked put, say, goes to $40. You're down 20 points. What you can do is, and see, we're in the 59-day expiration. You're in a 35.30 situation for, well, it's marking for 10 because we paid 10 for the put debit spread. So this thing has gone to $40. Okay. So what you can do, and I'm going to raise it to $40 just to show you. So here we are. Let me remove the put debit spread. and I hope this is not going to get confusing, but if you entered something at 20 and it's gone to 40 and you're nervous about it, first, you probably don't have to be nervous about it because everything we said, you have your put debit spreads working for you. You still have sufficient buying power working for you. The current market price is probably still hundreds of points above your naked put strike price. And you kind of want it to just sit there so your put debit spread can mature. And instead of making $50, you'll make $300 on that individual trade. But if for some reason you find yourself up, I don't really want to take a loss on this 111. But I'm not sure what to do. And your 20 has gone to 40. Well, you can look at this and say, okay, I'm going to cover this. So you buy this back, you incur the $20 loss, and then you look out, you look to roll this thing. So if we go out 10 days, let's go out 20 days. Okay, I got to go out 28 days because it's micros. Well, you can see that 37.40 that you were down $40 in, you can sell this one and bring in $63. So if you took in 20, because you did initially to cover $10 of the put debit spread, and you have $10 left to capture in the trade, and it goes to whatever it goes to, 20, and you're uncomfortable, you can cover the 20 and then roll out to a later strike and go capture the 20. I'm sorry, if it goes from 20 to 40, you're going to want to go capture 40 new points. So you cover the 40 and then you go look for another trade at $40. That's at the 35.60. So you were here, sorry. And if you go out a couple, why is this doing this? So to capture the 20 points, you want to capture the same 20. You can go all the way down to the 3,300 level by going out 28 days. If you only want to go out the next contract, you look for the $20 there. And that's going to be around the 34.50 level. So you've moved yourself away. Is it a roll? Technically, a roll is from the 35.30 down to the next 35.30. I reposition it. I roll it out. I bring in the same premium. I personally, if I'm in a 111 and I'm down, and I like to do it when it hits 30 points. So if I'm at 30 points, I've taken in a net 10. I'm down 20 points. I'll go out and I want to sell the 30 for 40. So I'm bringing in additional credit when I roll, and it's still pushing me out. I don't know if I'm explaining this great or not, but it's rolling. You're rolling out in time and down in price to move your strike further away from the current market. You can do it for no premium. You can do it for a little bit of premium. You can do it anytime you want to, anytime you're getting nervous, but you need to make sure your buying power percentage is low, because if your buying percentage is high, then you're not going to have the flexibility to do exactly everything you want to do. So did that make sense? Let's see. Let me see.
Absolutely understandable. Absolutely. I roll naked puts and calls all the time, depending on what's needed. But just to clarify, is that just on the naked put on that particular
yes
trade, or is that?
I would never do anything with the put debit spread. Now your first question is going to be, well, I had a 59-day put debit spread and naked put, and now I have a 59-day put debit spread and a 69-day or an 87-day naked put together with it. So then you've created a calendarized situation. So let's think about that for a minute. First, if you roll and you're not comfortable with that scenario of being calendarized, you can always roll and collect enough money in your roll to put on a new put debit spread. So when you take it from the 35.30 and you push it out, you can just push it out, and you're trying to capture 20 points, capture 30 points, and use 10 of those points to put on a new put debit spread, and that new 79 or 87 DTE expiration. I would leave the put debit spread on that you're rolling your position away from, unless you are very close, like within a week or 10 days of it maturing, and you can harvest a lot of money, not 50, but 100, 150, 200 points of that 300. If you're in a situation to do that, maybe you want to just take that money off and be done with it. Maybe you want to look at it. That's when you want to look at the tree. You want to look at that one trade and say, okay, do I want to leave this put debit spread on, or do I want to take it off? And that's always a choice, whether it's an older trade or a brand new trade. I have, and you've seen Bobby. Bobby's in a trade for 11 days and he'll pull the whole trade. And sometimes I'll be like, Bobby, why don't you leave the put debit spread on and just layer in a new naked put underneath it? Accounting wise, it's a little bit of a pain in the behind. He likes to keep his accounting clean. I do too, but I really don't like paying the extra commissions when I can avoid it. So I will not do that. I will leave the put debit spread on if it's early. Like if I'm doing a trade, I did a trade today. If the market turns around and rallies 3 or 4%, I can take this trade off probably and make 70 or plus % on it. And the put debit spread still has 53 or 54 days to it. Why not go ahead and reposition a new higher strike? You're in effect rolling up. You're closing your naked put, taking the profit and rolling it up to a higher strike in the same expiration and bringing in a fresh amount of profit. Okay. I do this all the time. I also have started, because sometimes when you get too close, like let's say you did some trades 6 weeks ago at the beginning of this rally and your put debit spreads at 35, 35, 50 in that range. It's so far out of the money that you really can't sell a naked put underneath it because there's no money to be made. In that case, there's all kinds of subjective things you can do, but objectively you have two choices. One is to take the put debit spread off and just reclaim whatever remaining money you can, or leave that put debit spread on as an additional foundation of protection for your whole campaign of positions. And I have found at Thinkorswim, because I am paying a ridiculous amount of commissions and because those mature put debit spreads that I put on for $10 in the first place, which is 50 ES points, it might be worth $8 or $11 or $12, and it's going to cost me $7.50 to take it off. Well, I'm not taking off a put debit spread to put $4 net in my pocket. So I leave that thing on. And if we get in a pullback like we're kind of experiencing now, but more we're experiencing in May and June, where it got violent to the downside, and earlier in the year, it got violent quite a few times. These way out of the money put debit spreads can very much come to life as they approach the end of their lifespan. If they are very near the end of the lifespan and the market starts going down, even though you're far away from that put debit spread price, those things can still go up in value and protect. And that's another learning lesson that I can verbally say, but until you feel it, you're not going to know. Okay.
This stuff is what you've gone through, and I thank you for going through it so thoroughly. But this is exactly what prompted the query and the question in the first place. So thank you very much. I know you want to move on, so
well, I want to move on. I'm also out of time. So again, you guys feel free to bail whenever you want to bail. And I appreciate, you tuning in. For those that are leaving now or getting bored because I'm too verbose, I apologize. It's my first session. I've never done anything like this before. I'm not as proficient with going from screen to screen. It's a little bit nerve-wracking. So I appreciate you all bearing with me. I am going to go in. So for those that want to bail, bail. And thank you for your participation. For those that don't want to bail, I'm going to go into this T-bill thing real quick. And I hope I've covered, before I get there, I hope I've covered how to adjust. Basically, you can do nothing. You can do nothing and take assignment. And if you take assignment, you have to know what your margin is and know what your total margining requirements are. You can roll, or you can just take the loss and leave the put debit spread on. And if you take a loss in a naked put, chances are that put debit spread is in the money. And at some point, it's going to pay you some money back. Okay. Again, any questions there? hit me up in my room, hit me up in a private message. I love them both. Let's go into this T-bill thing real quick. And then I think what we're going to probably do is have a fixed income session next time, because this is a whole nother universe of information. So let me get into the T-bill and what drew me to the T-bill. So I have my IRA account, which I'm posting on. I'm posting in my room. I'm posting my spreadsheet. Everyone knows it's about an $82,000 account. It's 81.8 right now. So I'm not too shy about what it is and everything else. This other account's a portfolio margin account. It's a low six-figure account. It is money that I have in the last 7 or 8 months gathered from some real estate sales that I had. Again, I have a 4-decade experience of investing and trading. I've done everything from day trading myself to managing a day trading room to trading futures, trading individual stocks. I did the Tastyworks thing from like 2019-ish, maybe early 2018 sometime. Went through the gambit of the Tastyworks thing. But I do have a background in fixed income. I have done financial planning. I've done budgeting. And what irks me right now with the state of fixed income is the money market accounts are not keeping up with the increase of Fed funds and Treasury bills. So it's rare that you can look at, you can look at my chart here. I have some stuff that I clipped right before the meeting. So this 1 month T-bill is paying 1.883%. A 3 month is paying 2.61. A 6 month is paying 3%. We'll stop there for a minute just for example purposes. So I don't know, last time I looked at my Ameritrade account, it was paying me 0.01. Well, I'm earning, and look, because I am building out my campaign of positions, and because my buying power is really never supposed to go much over 35%. Let's say I have a $100,000 account and my buying power is at 35%. That means I'm using 35,000 of my 100,000. The other 65,000 is sitting there earning 0.01. So obviously this is not a small account problem, because if you have 10 or 15,000, you really don't have enough money to worry about your excess funds sitting there earning nothing. And in fact, you might be cranking out a return on your whole portfolio based on its value instead of just the buying power that you're using, which is fine. But the larger your account gets, if it's not in mutual funds, individual stocks, or bonds, or God forbid, bond funds already, you're going to find yourself with a lot of excess liquidity that ideally will never get used. Ideally, you never want your buying power percentage to go up into the 40s or 50s or beyond. So a great way to enhance your return is by laddering in T-bills and increasing the return of your excess reserves. T-bills, treasury bills. Treasury bills are treasury securities that are less than 1 year. A treasury note is 1 to 10 years, and a treasury bond is above 10 years to 30 years. That's the current max, I believe, on a treasury. So that's where the T-bill, T-note, T-bond thing comes from. So in my opinion, what I'm trying to encourage people with this concept here to do is don't use the brokerage money market fund. Don't use an out of your brokerage money market fund, like go to Bankrate and look and see what the highest yielding money market accounts are. Ally Bank or whoever's looking for money and they need it and they don't want to pay the Fed funds rate, their rate's 1 point something right now. Ridiculously low. Why go with that? Go with the treasuries right here in your own brokerage account. Now, if you're Tasty, I don't think they do treasuries, so I apologize. IBKR does, Ameritrade does, everyone else, and Tasty may do it, but I kind of have a feeling they don't. So just take that for whatever it's worth. So what I'm encouraging people to do is take your excess reserves. So if you have 100,000 in your account and you're at 30% buying power and you have 70,000 sitting there that's not even used, and you have no intention of going above 50% buying power no matter what, you can take 50,000 of that and put it into treasuries and earn basically 3% instead of 0.01. Now, is that a big deal? No, but 50,000 at 3% over a year is $1,500. So it's like 120-ish, $125, give or take, I'm doing it in my head, a month of extra income for really doing almost nothing. And then the concept of laddering is you always want to have some maturing, like the Fed's in a rate hike cycle. So you want to have some T-bills that are near maturity all the time, because God forbid, if the market has a huge pullback and your buying power explodes, you don't want to go into margin. You want to sell one of your T-bills and re-liquefy your account. I hope that's making sense. That might be something we need to cover in an additional topic. But when you ladder in these and you could just do everything in a 1 month, you might be saying, well, Ed, this 1 month T-bill at 1.83 is 1.82 higher than I'm earning. I'm just going to put all my excess money in a 1 month treasury bill. There's nothing wrong with that at all. Maybe that's where you want to start. Just keep 1 month, 1 month, 1 month. And every time the 1 month matures, you put it in another 1 month. I'm laddering mine right now. I started with a 2 month, 3 month, 6 month ladder, and that's what I have working now. I'm looking at adding another tranche beyond the 6 month, give or take, because I'm still expecting the Fed to continue hiking rates. Now, I did post in my room, I think, and in the we created a fixed income room last night. So anyone that's interested in fixed income, if you go to the Trader Nerds Discord at the very bottom, there is a fixed income section. And if you go into strategies, is it strategies? No. Go into treasuries. I haven't posted it in strategies yet. I have a treasury yield curve website. Okay. And I can show you that real quick. Hang on, just with me. Bear with me for a sec. And again, anyone who wants to bail, thank you. I know I'm taking up a lot of time. My apologies. Hang on. Okay. All right, you guys see that? This treasury site? Are you seeing that? Everyone seeing this? You see what I'm highlighting? Okay, there's a yes. Thank you. Okay, so this is what I've done here. This is it's the treasury site, and you can look at whatever you want to look at. I'm looking at treasury bill rates. I'm looking at the current month. You can look at it year to date. You can look at past rates. I just like looking at the current month because I can see where rates, so you have a 4-week, an 8-week, a 13-week, 26-week, 52-week. Okay, so 1 month, 2 month, 3 month, 6 month, and 1 year. And then you can look and see where the respective rates were at any given point in time. So let me shrink this down a little. Okay, so right now, if you're looking at doing this, the 1 month is paying 2.18 according to this, and the 2 month is at 2.49. And then you can look back and see, like, let's just look at the 2 month. And this was as of the 22nd. So today's the 23rd. They haven't posted. Let me hit the refresh button and see if I can get a fresh rate here. Okay, it just updated. So we can see that the 23rd. Let's look at the 4-week. Rates went from 2.18 to 2.17 from yesterday to today. You can look at the 1 year. It went from 3.2 to 3.17 yesterday. So you can kind of look at these columns and see where rates have been. Or have we been in an uptrend? Have we been in a downtrend? We've been in an uptrend. Why? Because the Fed just raised rates. And when the Fed raises rates, these rates go up. And that's another reason you don't want to go out too far. And I'm blahing a lot here. I know I'm going to do a separate session on this if there's any demand for it all. There's a lot more to fixed income than what I'm going through here. But to keep it simple, when you're doing a replication of a money market account, you want to keep your rates short term, because the rate discrepancy between a money market account and even a 1 month treasury bill is asinine right now. Normally it's not like this, but market dynamics are making it that way. And one reason that is because banks are generally flush with capital. They've got more money than they can lend out. They don't have great rates to go invest it. So they're kind of clogged up. And so they don't want to pay higher money market rates because they don't have to. They just assume some of their capital run off. That's the current dynamic. Typically, money market rates will look at the 1 month T-bill and mimic that. So a usual, in normal times, money market rates should be above 2% right now, but they're just not, okay? So because we know with almost 100% certainty that the Fed is about to hike either 50 or 75 basis points in about a month, I think the next the next Fed meeting is at the end of February. Someone can look it up and let me know. I think it's the last week in September. I think it's the last week in September. Is there a penalty? The penalty for taking money out of a T-bill is the market price. So let's go back. That's a great question. Let's go back. Let me see if this is where it is. Okay. Okay. So we're going to go back here. So right now, let's just look at the 1 month. You see it's priced at 99.8827. So for every $100 of T-bills you buy, you pay 99.827. Now, I know your initial thought is, what the heck, dude? I'm going to only make 0.173. Well, that equates to but it's in a month. So you're making 1.83%. Okay. Seems like a little bit of a pain, but you got to keep that end rate in mind, this 1.83. Now, when the Fed hikes rates, this 1 month might be paying 1.9 or 2%, in which case there's an inverse relationship between existing bond prices and yields. So when yields go up, existing bond prices go down. It's an unusual concept. Most people find it very unintuitive. If you get used to the concept, it's real. And the reason it's real is when rates rise and existing bond prices go down, that's because rates have risen. And if you buy a brand new treasury, 1 month treasury, and it's paying 2%, then your 1.83% has to go down in value to make it yield 2%. A lot of words. I don't know if that concept is familiar or not. But again, depending on what's going on here, unless the Fed hiked many percentage points on such a short security, it's not going to move much at all. So you're not likely going to lose money on a treasury bill. But if you went out to a year, for instance, where rates are at 3.11%, and we find ourselves in an elevated inflationary environment over the next 6 months, and the Fed hikes 3 more percentage points, and a 1 year is now paying not 3%, but 5%, which would be crazy, but who knows, anything could happen. You may incur a 1 percentage point loss in that, or some amount to make it notionally rate equivalent with a brand new security. Don't know if that's going into anyone's ears and registering, but again, it's a concept we can look at in the future. And again, the bigger your account and the more money you have to do something with, the less likely you are to have a worry, because you're going to be earning hundreds, if not thousands more every year. And if you have to give up some of that because you need some liquidity for whatever reason, then okay. But generally, to start with, I would stick in the 1, 3, and 6 month range. That's where I went. I'm looking at logging into another one in the 6 to 9 month range, because my 3 month is now getting to like 1.5 months. So when the Fed hikes in a month from now, that one's going to be maturing. I'm just going to roll it into a new one at whatever maturity I want. I hope that makes sense. I hope people maybe see some validity in this. Y'all have any questions at all? This might have been complete gibberish to everyone. Okay, no questions. Who else has any questions? Do you want to look at my portfolio? Do you want to look at my spreadsheet? Do you want to tell me I'm putting you to sleep because my voice is too monotone? Where do we want to go?
Can you tell us how to do this on TD Ameritrade?
Yes, beautiful. Is this RR speaking right now?
Yes.
Thanks, RR, whoever you are. Thank you. Okay, let me go to that page. It's not hard. They have a dedicated bond department. And you just call them. And they're happy to help you. You may have a little bit of a wait.
You have to call them?
You don't have to call. Okay, so look.
Oh,
So
you
I'm
don't?
going to take you back. So you log in, you go to research and ideas. I'm going to go back to the beginning here. Okay, come on, computer. So you go to research and ideas, and then you go to bond and CD wizard or advanced search. You go anywhere in this section. Just go to the advanced search. It brings this page up. You click on treasuries. You want to do this with treasuries and not CDs. Both treasuries and CDs are AAA rated. CDs are FDIC insured up to $250,000 per CD per registered name. Treasuries are unlimited, backed by the full faith and credit of the United States government, which admittedly is not what it once was, but we're the least sick investment credit on the planet. I'll put it to you that way. Then you have agencies. Those are things like Fannie Mae, Freddie Mac, Federal Home Loan Mortgage. You got the Federal Farm Credit. There's all kind of governmental agencies that either have a direct government backing like Fannie Mae's or an implied government backing like Freddie Mac's and Federal Farm Credit Bank, et cetera. Then you have municipals. Municipals are generally tax-free. Those are issued by cities, states. Sometimes they're issued by projects like sewage departments. And usually they're tax-free. So, and this is where we may get into a different bond session. I'm going to go ahead and stick to how to buy them. We're going to have another session. We'll have another session on all this stuff, and we'll cover it. So anyway, you want to click on treasuries. It brings you here. And then you want to put your parameters in. Now, T-bills are sold at a discount to face value. Like I just said, you might be buying $100 worth for $99, for instance. Other treasury notes, treasury bonds, you buy 100 for $100 worth for 100, and it pays a certain amount of return, say 3%. And if you buy a new one, great, you pay 100 per 100. But if you buy one that's in existence, you might buy it at 100, or you might buy it at 99.5, or you might buy it at 100.5, and then you get a coupon. So you have to pay the price of the bond, which is based on what rates have done since that bond came out, because when rates go up, existing bond prices go down. And it's got that set coupon. It's been earning interest for a certain amount of time. You have to buy that interest, and at the first coupon payment, you get it back. Anyone that's dealt with bonds knows what I'm talking about. Anyone that hasn't dealt with bonds, I just threw a whole bunch of Latin at you, and I apologize. I'm going to circle back. The reason I'm explaining that is because treasury bills are sold at a discount. So I really only want to look at treasury bills that are like at 99 or less. Okay, that's the maximum price I want to pay, because it'll pull up only treasury bills. And look, you can click treasury bills here. My yield, I'm just going to put a 1.8% as a minimum. Okay. So I've kind of just done this to help my screen a little bit. I don't want to ever look at anything over par or at par, because it's not yielding anything in a T-bill. I don't want to look at anything less than a 1.8, because we just looked at our chart and we saw even a 1 month pays us 1.81. So it'll capture all those different things. Then you go down here and you search. Okay, this is what comes up on the search. And this is where I clip these other things from. So here's a 1 month. Paying 1.84, it's priced at 99.8. Let's look at like a 3 month. Okay, here's a 3 month. That's about a 3 month, this one right here. Oops. So it's selling at 99.52 to yield 2.59%. Now let's say you like that one. I've got 20 extra thousand. I've got 50 extra thousand. I'm going to put 20 of it into this T-bill. So you just click buy. It takes you to the screen. And these are the different pieces they have. Okay, these are, and you want to buy 20,000. Okay, these are all in thousands. So you just say, I want to buy 20. It's going to calculate the cost for you. Okay. So you're going to pay 99.355. It's going to cost you $19,871. And that's it. You click buy and it sends it in. The commission, to let you guys know, is very, very low. Oh, let me show you something else. So I hope everyone kind of got that. The commission is low. The commission is anywhere from 20 cents per thousand to $20. Now I asked the guy, how does that work? And he's like, it's on a grid. I can't really explain it, but no one basically ever pays $20. So I gave him some different examples. And the most he really came up with was $2 per $1,000 of bond. I never could get an example that was higher than that. Okay. So it doesn't even show the commission here. I think it's built into the price. So this is going to be your yield with the commission, which is the 2.58. You see the 2.58 right here? Right there. Okay. All right, let me show you something else. If you click on new issues and you go to Treasury auctions, see that? And you look at Treasury auctions 0 to 1 year. I'm not going out in time. Anyone that wants to do a longer term bond, private message me, we'll have a conversation. You may have a purpose for it, but that's not what I'm here for today. I'm simply trying to replicate a money market account without too much headache. So we clicked on new issues, we clicked on Treasury auctions, and this gives us upcoming treasuries. Look, here's one that's going on day after tomorrow. 4-week and 8-week treasuries. The little circle says it's available. So if you want to do a 1-month treasury bill and don't pay any commission, you come in here, you click that. You go down here, you tell it how much you want to buy. If you wanted to buy 20,000, you hit 20,000, you review your order. And there's your order. Okay, so you're going to buy 20,000 at whatever the auction is on August 25th. It's going to mature on September 27th. You pay no commission. So the auction, just to explain that, the auction goes off, and the average price of the people put in bids. The auction is an auction. The government comes out and says, hey, we have 1-month treasury bills, come feast. And everyone puts their orders in. We want treasury bills. We want 1 month. And it's you, it's brokerage companies, it's whoever. Okay. And people put in the big people put in a rate. I want to earn 1.9 on my 1-month treasury. And then you'll have a whole bunch of people like us that we're just going to take the average that all the players are going to set that rate. If there's a lot of demand for an auction, rates will be lower. If there's little demand, rates will be higher. So whatever the auction result is, it sets an average yield. And if it's, say, 1.9%, someone might have gotten 1.92 or 1.93 if they had $100 million. And they're like, I'm putting in $100 million or whatever it is, even more. Because sometimes these treasuries are for billions of dollars worth of auction money. So the more you put in, the more kind of control you have at what rate you want to receive. anyway, all the competitive bids are lined up and they determine an average rate, and that's what you and I get. So whenever the average rate is done, boom, this thing gets filled on the 25th and it settles into your account, I think the same day. Oh, look, I'm sorry. The auction date is 23rd. It closes on the 25th. So we're in it. It started today. It ends on in 2 days. In 2 days from now, it'll go into your account and it'll tell you, you have 20,000 and you're earning 1 point whatever on it. And that's it. You got in it. You didn't have any commission to pay or anything else.
It says
Okay.
settlement date 8:30 right there. August 30th.
Thank you. I'm sorry. Good deal. I apologize. Okay. Yeah, thank you for that comment. My bad. Are you guys kind of getting a feel for this? Again, Ameritrade has a dedicated bond department. Let me go back and show you that number. Oh, look, it's right up here at the top. And it's on every fixed income page that you go to. 877-883-2835. They're generally a happy bunch. Sometimes I talk to them and they're a little cranky, but hey, you know. So they're happy to help you if you want to do this. I'm happy to help you if you want to do this. If what I've said is interesting to you and you're only getting 50% of it and you feel like you're a candidate, private message me. I'll be glad to have a back and forth conversation with you. I'll even get on the phone with you if you have an urge to get on the phone. I have no problem with that either. In my months of being a volunteer here at Trader Nerds, I've had about 4 phone conversations, not too many. But I'm available for that just because I like it. What other questions do we have? I'm way over my allotted time. No one's going to slap me for it. I hope this has been informative. If you need more clarification, please go to my Notional Ed's Journey room or private message me, as I've repeatedly said, and I'll be more than happy to spend whatever time you need to go through these things. Any other questions? Is there anything you want me to post?
So when you're laddering this, are you just like splitting up your available cash and then just
Yes.
evenly putting it into the
Yeah.
each step,
So-
each piece of the ladder, I guess?
Yeah. So what I'm finding is, again, my buying power and my portfolio margin account is something like 13% right now. So for every 100,000, I'm using 13,000. I don't ever plan on going above 35,000, except even in a massive pullback, it might go. Like in May, my buying power went up to from 25 to 54% in about 3 days because I didn't do any adjusting. I did some adjusting, brought it back down to around 30. The market stabilized, the premium came out, everything was good. Okay. So what I'm doing is I'm kind of taking half my portfolio margin account and splitting it into 4. And I'm personally doing 1 month, 3 month, 6 month, 9 month, knowing my 9 month and 6 month especially are going to encounter 1 or 2 more Fed hikes. So when the Fed hikes, the new 9 month or 6 month is going to pay more than the 6 month or 9 month that I just bought. So I'm doing that knowing that, 1, I'm going to be earning almost 3% between now and those future hikes. So I'm willing to take that loss of future rate to get some rate now. And so I split it into 4 and I allocated 3 of the 4 segments, with the 4th one being dedicated to the September meeting. So I'm going to have one that's almost maturing when the September meeting happens, and one, I'll call it tranche of money that's just sitting there. And I'm going to roll those 2 into 2 more tranches after the next Fed hike. Is this available in an IRA? Yes, these are available in an IRA. There's no reason not to do it in an IRA. Again, I have to caution you, and I want to be very clear. If you have 100,000 and you're at 30% buying power and you take 50,000 and you put it in, you still have 20,000 more in buying power to use up before you incur a margin loan. Not on margin. All this stuff's in your margin account. There's a difference between operating in a margin account and going above and beyond your buying power and creating a margin loan. So
But that wouldn't be true in an IRA.
no, because you can't go above. You're just going to get a margin call.
No, I mean, but you won't, like, if you have 100K in your IRA and you put 50K into it, that's gonna take 50K buying power.
It will. It will. But you really shouldn't be at 50% buying power in your $100,000 IRA anyway, because you're way over leveraged. No one should be up in the 40 and 50% range unless you have like a $10,000 or less account and you're kind of pushing the envelope in. Again, I have conversations with people that have 8,000, 10,000, 11,000, 12, and they have on like between 3 and 6 111 or 112s. It's a small campaign, but relative to the size of their account, they're up there. Clearly, they have no interest in a T-bill. They're not even a candidate for this T-bill thing. But if you have 50 and 100,000 in an IRA and you're at 20% buying power, and you know in your mind you don't want to go beyond 40%, and you're not going to let yourself go beyond 40%, then you can put that other 50 or 60 into T-bills and earn that extra, $1,500 a year on it. It's much better than a goose egg. And if you see yourself in a situation, even intraday, like let's say we wake up tomorrow and the market's down 7%, and your buying power went from 20 to 50, and you've already T-billed yourself in, you're like, oh my God, I don't have enough buying power. Just go in and click. And if you've got $30,000 worth of treasuries, you can sell 10 of them if that's all you need to reliquify your account. Then you make your adjustments, get your buying power under control, let the dust settle. And when it settles and you're comfortable putting the money back in, you do it. Again, the bigger your account, the more excess money you have sitting there earning zilch, 0.01, the more motivation you're going to have for something like this. So I'm just trying to bring value to you guys that have excess reserves, that aren't in mutual funds, that aren't in stocks or anything else. The other thing I want to touch on briefly is I am hugely, of all things I'm against over leveraging your account. And right next to over leveraging your account is buying a bond mutual fund. So bond mutual funds are not good, because anyone who's got a bond mutual fund has experienced what bad can be this year, because those bond funds are probably down as much or more than your mutual fund holdings. And that's because the Fed has gone from 0.5 to 3%, all the way out on the yield curve out to 10 years. We were at like 0.7 or so at the beginning of the hike campaign. Now we're, I don't know where we are on the 10, but probably a little under 3%, 2.9. I'm not sure exactly where we are. But again, when rates go up, existing bond prices come down. And if that bond fund is made up of thousands of individual bonds, as rates go up, the value of those bonds is coming down. With a regular bond, if you buy $10,000 worth and rates shoot up, and now it's only worth $8,000 instead of $10,000. If you hold it to maturity, you get your whole $10,000 back. The cost to you is I'm earning a pathetically low yield that could have been higher if I waited. But you're going to get your money back. In a bond mutual fund, it's just all these bonds that are being bought with new money and sold and redeemed when people redeem and when they mature and they're getting reinvested. There is no real maturity point for a bond mutual fund. So when catastrophe hits for a bond, which is a rate rise environment, your holdings, unless rates squish back down to below 1%, you're not going to recover the money you've lost on your bond funds, I'm sorry to say. So probably bringing this lesson to everyone a little late, the few of you that are here listening, but I don't like bond funds. They're not good for you at all. The only person they're good for is the broker selling it to you and the bond portfolio managers who are making their management fee. They are not good for you at all. So I guess I'll leave it at that. I do want to have another fixed income session. Oh, let me point this little tidbit out to you. On T-bills, T-bills are not taxable on a state and local level. So if you're in a rare city that has an income tax, like New York City, no taxes due on treasuries of any kind. No state taxes due on treasuries, but you do owe federal taxes. So that's another little advantage of the treasury, is if you're in a high income tax state, you can save that extra amount of tax that you would otherwise pay.
One
Yes.
question then,
Yeah.
since you're doing 1 month, 2 month, what did you say, 6 month, 9 month,
Yeah,
or 1 month, 3 months, 6 month, 9 month?
great question.
Then,
So
then when
it
your 1
is,
month, when your 1 month matures, then do you roll that into the 9 month at that time?
or whatever your preference is. When it matures, again, ideally you would want to, if you have 50 to invest, maybe you want to take 15,000 and put it in 3 different ones. Or maybe you want to put it in all in 1 month and just count your blessings. You're not earning 0.01, you're earning 1.8 something. That's up to you. Because the 1 month rate is at 1.8 something, and because the 6 to 12 month rate is pushing 3% or a little above, I'm willing to take part of my money and put it out in the longer term so I can capture an extra 1.25%. Knowing in all reality, I'm not going to need that money. When will I need the money? So in that account, I'm selling SPY puts. So if we have a big pullback and I actually get exercised on and have to buy a whole bunch of SPY, I don't have the liquid money to do it. I only have half the money to do it. So I'll end up having to go in and sell those treasuries to pay for those SPY contracts that I'm getting assigned. So just like your preference on when you want to roll, do you want to defend, how much buying power do you really want to use? The chart says 35. I'm at 18. I'm comfortable at 18. I don't want to go above 20 or 20. These are very subjective things. So you want to go longer term with the T-bills because you're earning more yield. By the same token, you are locking your money up and subjecting it to a little bit of tiny risk. If rates really shoot up a lot, you might have a little tiny principal loss. I doubt it, because by the time it happens, you're probably going to have earned some money on it. It might be a break even. Like you might buy it at 99, it's gone up to 99 and a half. Things go against you or whatever, and you got to sell it at 99. You've just given up the interest that you earned. A little blah, blah. I hope I'm not going, too out there on it. I'm getting back to the yields. To answer your question, yes, these are annual percentage yields. So that 1.8 that I was showing you is 1.8 per year. So you're only earning the 1.8 for a month, but it is 1.8 annualized. I hope that makes sense.
You put that in the wrong spot, I think.
I did. Thank you.
Oh, are you on CDs again? You're on CDs now.
Oh, thank you.
What is the coupon versus the yield there?
Okay, the coupon T-bills are sold at a discount to face value. They don't pay interest in a coupon. Treasury, and that's what T-bills do. So T-bills are sold at a discount. Treasury notes and bonds are sold at par value, which is 100 per 100, and pay a stated return, say 4% or 3%. And then you wait 6 months or whatever, and it pays you your interest. And every 6 months, you'll get your coupon payment. So if you buy one today and you have to sell it next week, your 100 per 100 may not have changed much because rates haven't moved much, but you will have earned a little bit of accrued interest, like at 4% on 10,000, you're earning $400 a year. So that's like $30 a month or $35 a month. So using that example, if you're earning 35 a month and you're 1 week in, you've earned about $7 of interest. When you sell that bond, whoever's buying it from you owes you the interest that you've earned. So they're going to buy the bond from you, say at 100 per 100, and they're going to pay you the extra $7 that you've earned while you've owned it. And then they will recoup that when they get the full interest payment at 6 months from now. So if it was 4% and they're earning 400 a year and they get 200 a year every 6 months, they're going to get the full 200 in 5 months and 3 weeks because you've earned 1 week of that interest. Does that kind of make sense? No, Ed, you threw too much at us at one time. Okay, so I want to go back into this, just show you real quick.
So if you have to sell it, do you just sell it at, is that easy to do?
It's very easy to do. You go in
Same
here,
thing.
it'll be in your account, it'll be in your positions. You probably click buttons just like I'm doing here and sell it. And again, you can always go up here to the Ameritrade people and give them a call and say, hey, I'm a newbie, help me out. And they'll help you out. Okay, this is pulling up something. I need to refine my results. See, this is showing, you see Treasury notes, you see NTS, that means it was a note. That means it's not a zero coupon. See a T-bill, apparently I don't have any T-bills in here. I don't want to go here. It's going to be too much.
Do
Don't
you
make-
put notes bonds only?
Yeah, thank you. Who is this talking? RR. Who is this?
This is Randy.
Oh, Randy R. Okay. good,
Randy R in
Randy.
the
I'm
Discord.
glad you're in here. You were one of the original question askers, so thank you. I'm glad to hear you're in here. So we're back to the Treasury bills. Treasury bills are sold at a discount. Treasury bills do not have a coupon, so they're all at zero. They pay zero. They're sold at a discount. They're sold for less than 100 per 100, and the thing matures for 100, and that's how you collect your interest. Notes and bonds don't generally pay zero. There are zero coupon treasuries. You've probably heard of them before. And they had a much greater purpose when rates are higher. With rates where they are now, I don't like. So yes, all these quoted yields or the annualized yield. So if you divide 1.84 divided by 12, you're earning about 12 or 15 basis points, something like that for the whole month, which is not much, but you're only earning 1/12 of 1 basis point in the money market account. Now you're earning 15 basis points. You see, so, and again, if it's not a lot of money, you're slicing and dicing, it's not worth the headache. But if you have, in my mind, anything, even the 100,000 example where you're taking 50 and you're putting it in and you're earning 3%, and you're earning $1,500 extra a year, that's 1.5%. If you're targeting a 10% return, trying to do the 111 and earn 10% pretty conservatively, that extra 1.5% net that you're adding to your gross account, because you're only earning it on half, you're earning it on 50, not the 100. It's raising the whole portfolio rate by 1.5 percentage points. It's nothing to spit at. And, again, the more capital you have, the more appealing something like this is going to look. What else? Thank you all. It's been a pleasure. Thanks for
So
sitting
I'm
here
not
for
sure if
almost
you
2
answered my
hours to you dedicated 13 people who are still here.
Not sure if you answered my question.
Oh.
You kind of did, but so your plan is on the ladder is to eventually have all longer term maturities, right? But maturing like each month. So the first month when you do this, you only have a 1 month and then a 3 month and a 6 month and a 9 month. But eventually you want to get all 6 month or 9 months.
No, not really.
Maturities.
The principle of a ladder is you want to ladder it in time. So the first one might be at 1 month, and your second one might be at 2 months or 3 months. The next one's going to be a little month or two longer than that, and a month or two. So as time goes by and all those are heading toward maturity, your 1 month matures. And then your, say, 3 month you had behind it is now 2 months from maturing. So maybe it's up to you. Maybe you want to take that just matured one and your 2 month and your 4 month and your 6 month that you have, for instance, and take that just matured one and maybe make it another 1 month. So in a month, you'll have another one maturing that one. And a month after that, you'll have the one that's 2 months from now maturing. Does that kind of make sense?
So how do you decide which one you're gonna buy when
Well, I
when
would
one
look at that.
matures?
I would first see how all this feels to you. At that point, you've been doing this for a month or 2 months, or has this impaired your trading? Have you found yourself stressed about my buying power percentage? And look, the treasuries, these treasury notes, 1 year and less, they only take up 1% of your buying power. So if you put 50 out of 100,000, it's only holding aside $1,000 of buying power. So you can still treat the whole 99,000 that's left. What I'm trying to explain there is you don't ever want to go beyond the point where your account says option buying power. When that gets to something approaching zero, that means you are way overdoing it and you need to liquefy some of your treasuries. Now, that also means your buying power is through the roof and you should have been lowering it anyway. I'm getting a little off subject, but these are very nuanced trader specific things, like how big is your account? How did you set up your ladder? Are you comfortable earning the extra money? Is it worth a little bit of headache to learn and figure this out? So again, ping me in the future. Everyone here sees, how to see, you all know how to private message, I'm guessing. If you don't know how to private message, you basically go into the Discord room, and at the top left, you click on the little, it's the top left button. And when you highlight it, it says direct messages. You click on that, and then you can find or start a conversation. You click it in there. You can just type Notional Ed, and it'll bring me to there. Like
Actually, they can just click on your name anywhere.
Okay. All right.
And anywhere there's a message that you typed, you can click on your name and it'll
Beautiful.
private
So
message you.
I mean, it's subject to your level of trust of me, a total stranger, but one, I'm free. Two, I don't make any money off of what I'm suggesting to you. Three, my only motivation is to be helpful. So those are not things you're going to find from a broker. So, and you'll just have to decide if you want to trust me in a private conversation or not. All I can tell you is I have probably had 70 private people on private conversations over the months. And we discuss all kinds of things. Again, from I think a $3,000 account all the way up to a $4-point-something million account I talked to someone about. And I got the financial planning and brokerage background, and account is an account. It's all relative to you. 11,000 to one person might be like 2 million to another. So everyone's money is everyone's money. I offer my services. Let me know. I want to go back, Randy, real quick and just answer your, where do I put the maturing T-bill? You plug it in based on looking at where else. If you're just doing a 1 month, 1 month, 1 month, that's easy. You just do another 1 month. If you have a 1 month, 3 month, 6 month, and your 1 month matures and now you have a 2 month, 5 month, maybe you want to buy a 1 month and have a 1 month, 2 month, 5 month. Or maybe you want to take the one that just matured, you still have a 2 month, 5 month. Maybe you want to go into 3 or 4 months. Maybe you're like, okay, I'm really probably never going to use this money. I see that now. Let me go out 9 months. Let me go out 2 or 3 months beyond my longest maturity. And that way you always have one that's like 1 to 3 or so months from maturing. So the closer they are to maturity, the closer they are to 100 per 100 value, which means the less potential penalty you might pay getting out of it. I don't anticipate really much capital loss unless the Fed hikes 2 to 3 more percentage points, full percentage points. I don't see where these shorter term T-bills are going to be impacted very much at all. Again, once you buy 1 or 2, just like your 111s, you're watching them wiggle around, watch your treasuries wiggle around. I watch them. I don't watch them. And I've got a 6-figure amount in T-bills. So I'm not really paying much attention to it. I know I'm not earning 0.01. I'm earning between 1.8 and 3%. How am I going to go wrong? I can't go wrong. And if for some weird reason, all my SPY puts get put to me next month because we've had a classic September/October plunge, you know, the least of my worries is going to be taking a few $100 of hit in my treasuries if in fact I've had a hit, because rates are probably going to also be falling because there's a flight to quality. You know, when the market falls, generally rates fall with it because everyone's leaving the stock market and flooding into bonds for, quote, protection, if that makes sense. So does that kind of cover it, Randy? Really, it's whatever's in your comfort zone. Just as if you were trading a 111 and you're doing 60 days or less and you get down to 41 days and you have a 41-day or a 61-day contract to get into, which one are you going to get into? I'm asking hypothetically. Don't answer. You don't have to. I am going to look at the return on the 41-day and the 61-day. I personally lean toward the longer maturities. There's a whole bunch of people doing 30 and 35-day 111, 112s. They don't want the market exposure less than that. They want to just make their money. The put debit spread matures quicker, yada, yada, yada. That's fine. But load up a 41-day 111 and then click it to the next cycle that's 2 weeks or 3 weeks out. Sometimes by going from 40 to 60 days, you'll earn twice the amount of money. So I'm like, well, I can bring in twice the premium by extending my maturity by 50%. So going out 50% more on maturity and collecting twice the premium seems like intuitively, it seems like a good deal. Yeah, my behind is on the line longer. If there's a market plunge, I have to live with that potential for 61 days, not 41 days, but I'm doing this on a whole campaign of positions. That, you know, it's very subjective. And this T-bill thing is subjective. My beginning suggestion is if you ladder, you do a 1 month, 3 month, maybe you want to do a 1 month, 2 month, 3 month. And in a month from now, you'll have a 1 month and a 2 month, and you just want to go out and just keep doing a 3 month. Every time one matures, you go to 3 months. You always have a 1, 2, and 3 month. Look at your yield on that resource center page on the Treasury and just see, it's not worth 15 extra basis points for me to go from 3 months to 6 months. So I'm just going to keep it at 6 months. It's kind of a subjective choice. Also, as the Fed ends its rate hike cycle, everyone's going to be speculating on when rates are going to get cut. And if you're too short term, when rates start coming down, your stuff's going to mature and you're going to have to reinvest it at a lower rate. Who cares? You're not earning 0.01, you're earning 2 or 3%. Now maybe you're earning 1.5 to 2.5% in the same maturity range. You're still earning way more than 0.01. You almost can't lose doing this. This is not a risky endeavor in my mind at all. It's just a quality place to park your excess funds. Look, I was doing this for months before I realized, idiot, you got a 6-figure amount in your account you're likely not going to use unless the market has a 12%, 15% pullback and you start getting put some SPY. You're just going to let that money sit there earning nothing? And it dawned on me like, idiot, go buy some treasury bills. And that's when I did it. And I've been doing it for a few months now. And I just put it out there like a week or two ago. I think, Randy, you were the first one to comment on this. So I didn't know if anyone had any interest in this or not. But to me, it's a definite. And if you've never seen any of this before, a lot of it is Latin. A lot of it is foreign, just like this whole 111 thing. A lot of it is very foreign to some, not as foreign to others. But you can see the benefit of earning money on your excess reserves with little to no risk. So that's the big thrust of what I want to present with this bond, short-term treasury bill. I hate to even say bond. It is a type of bond, but it's not a treasury bond. It's not a treasury note. It's a less than 1 year treasury bill. Some of the most liquid, some of the most solid credit on the planet. So it's not a high risk thing, and it's a lot better than earning 0.01. So that's where I am on it. What else do you guys have for me? Do you have any topics for the future? If you would email me in the future, message me or whatever, that would be great. I'd like to do 1 or 2 of these a month. I would even do one weekly and try to stick to the hour and maybe just cover one topic next time. So it's kind of all new to me. I enjoy joining Bobby when he does his sessions. I feel like some of my ad libs help. And I enjoy contributing when I can. So if you guys can come up with some topics that you have an interest in, I'm willing to cover almost anything. And if I don't personally have the knowledge, I'll go out and solicit that knowledge either from the room or elsewhere and deliver it to you. So I'm just looking at enhancing our content on the Trader Nerds Discord. And I hope everyone's enjoyed it. I want to leave this open to everyone as much as possible. Like I think it's going to be for all premium nerds going forward, just like it was today. And just hit me up with your topics. And again, please feel comfortable with private messaging me if you want to do that. And if you want to have a phone conversation, I'm fine doing that too. Here, I'll put my phone number in the, maybe I should just put it inside my name where you click on my name and the information's there. Maybe I'll just do that. Here, I'll put it right here too. There aren't too many people left. But yeah, like Bobby says, get Ed started, he never shuts up. So I'm very quiet at the beginning and very verbose once I get my dust wiped off. Once the rust is gone. So reach out if I can help in any way. I'm more than happy to. Everyone have a great day.
All right, thanks.
You guys take care.
Thanks, Ed.